Well, good morning, Southern Oregon. Welcome back to the Real Estate Show. So glad you could join us today. We have two really smart financial people coming to talk to us about finances and mortgages. We've got Mutual Mortgage Team Guy Giles from Medford here locally, and also Micheal Ronchetti. He's the Regional Vice President of the Northwest of Mutual Mortgage. So going to pick their brains about the volatility this week, possible interest rate increases, the economy in general, and what's coming down the pike for the rest of 2023. So we've got Micheal Ronchetti and Guy Giles from Mutual Mortgage. Super excited to have them on the show today. Before we get them into the studio, let's check briefly with our local stats. So this week, let's start with Jackson County. This is for single family home residential only. We've got prices up year to date, 6% in Jackson County. The average residential home will now cost you $515,995. Congratulations to Jackson County for having an uptick. The number of solds year to date in Jackson County are down 22%. With 245 residential sales this week. And the number of listings in Jackson County are also down 12%, with 960 active listings on the market. Josephine County prices are only down 2% year to date, and that puts us at an average of $455,333 for a residential home in Josephine County. The number of solds year to date in Josephine County are down 7%. We had 92 closings this week. And the number of listings in Josephine County year to date are down 9%. We had 460 active listings in the residential market in Josephine County. Klamath County prices are down 8% year to date this week, with average $321,155. The number of solds in Klamath County are down 14% year to date this week, with 89 closings in the residential market in Klamath County. And the number of listings in Klamath County year to date this week are up 19%. So a little bit of good news in Klamath County. There were 368 active residential listings on the market this week in Klamath County. So again, the stats are still mixed, but we're starting to see strength a little bit here and there every week. We're so happy, and that's why we check this every week. In the meantime, let's get ready to bring Guy Giles and Micheal Ronchetti from Mutual Mortgage into the studio. Don't touch that dial. We'll be right back. Well, good morning, Southern Oregon, and welcome back to the Real Estate Show. We have an amazing show for you today. We get two great minds. We get Guy Giles from Mutual Mortgage and also Micheal Ronchetti, who is the Regional Vice President of the Northwest for Mutual Mortgage. Welcome, gentlemen. So glad we could have you on the show today.
Hey,
Great to be here.
Man, yeah, maybe the last nice weekend of the year, huh?
Well, we had quite a lot happen in the financial world. Where should we start?
Gosh, I guess I don't know. We had some pretty good ADP numbers come out around Wednesday, and everything was looking pretty good. And then the jolts came out on Friday and kicked us in the teeth a little bit. But I guess, more important than just that, maybe breaking down what happened with that. And I think a lot of these jobs that happened, at least every month we get jobs numbers, and every month this whole year they revise those job numbers down from the previous month. So this month, instead of revising them down, they actually went up, along with almost double the jobs that were supposedly created. And I say supposedly because me, I don't really trust anything anymore. But we had $190,000 or 190,000 revision last month on the jobs up, and they were all government jobs. So
does that mean the government's hiring? Is that what that means?
Yes, along with 70,000 of our jobs for this month. So in my opinion, they're a consumer. They don't really create wealth at all. If
Gotcha.
anything, you just put, however many 100,000 people in there that will create more regulation that could potentially. I'm not trying to go negative, honestly. But it's real. If you are only hiring government jobs, they don't generate any revenue at all. They're just a sucker on the economy. Not to mention regulation that they put in, which hurts building, it hurts everything that we have anything to do with at all. So I guess what I'm trying to say is that we will have to see how investors digest this information.
And the reason the jobs
really
report is important is because for us in real estate, why is that?
Well, because mostly because the Fed, their function is supposed to be inflation, but they're more focused on job numbers right now. Even if most of our job creations, especially since COVID, have all been in the hospitality, and they're not all full-time jobs. Most of them are not. Actually, the average worker in America now is only working 34 and a half hours. So it's all skewed, and I like I said, I mean, I'm not a negative guy in general, but at the same time, I don't think that these numbers show such a strong economy that the Fed should just be raising rates again. And that's what this is all about. Their one mandate is to try to keep inflation under control, at least historically. And what's happened over the last few years is everybody just keeps pointing towards job numbers. But if you have two jobs that come in and they're both part-time jobs, or they're just a government job, none of that speaks towards a really strong job market, in my opinion. And I don't know when it'll come to roost. I don't know how. I don't know what the mechanism will be. I know something's going to happen before this election. Otherwise, I don't know what they're going to point at and say, this is working well.
Mm-hmm.
So,
I think a lot of the things that are coming into when you talk about the numbers, because as one person has told me, and I've used the term a lot, obviously in the last couple of months, is you have to have your head on a swivel. With the numbers, there's a lot of manic depressant numbers going on in the marketplace. You get the ADP number, it looks really low. You get the government number, it looks high. A lot of the reasons for the inconsistencies over the last year and a half is because we had 2 years of never seen before. We've never shut an economy down to the size of the U.S. and even in any relative terms in any other part of human history. So you don't know how to digest seasonal adjusters. You don't know what's going on. What we are seeing, to Guy made some comments, especially that hourly comment. We're seeing a lot of second jobs coming back in. What does the government, in this number that was released today, what do they consider a job? An Uber driver or someone that sets up their car as an Uber because inflation is out of control and affecting how they can buy eggs and food and so forth and pay the bills. Now they have to take an Uber job. Well, that counts as a new job in the overall number. So you really have to digest what is coming on. Ultimately, I've gotten back myself personally. I've gotten back to looking at a number I used to look at when I was in school for economics is consumer sentiment. Because everybody keeps saying, hey, if the numbers are so good and the economy is so resilient, why is consumer sentiment going down? Why does everybody disagree with the political environment we're in? Well, it's because, maybe that's the real telltale sign that we should be looking at and going back to the basics on the economy. In theory, you would think job numbers creating would be good for real estate and for what we do, even in a higher rate environment, because people can afford the higher rates. Because things are going good. But in fact, we're kind of seeing, like to Guy's point, I think a lot of that dip in the hourly numbers and where that's trending should be of concern on the type of jobs that are being created right now. Of course, we're also getting into the holiday season, the early hiring for the holiday seasons, and where FedEx hires 30,000 people to run all the FedEx packages and so on. So we're going to see some skewing in the job numbers, I think, over the coming. What's going to be numbers to be looking at next week? We've got the CPI number.
Mm-hmm.
we have the PPI number, which are two big ones for the Fed overall. That is your inflationary numbers, and the pressures are going to be built there. But I would say keep an eye out on the consumer sentiment on where this market goes into 2024, and ultimately where rates are going to be going.
Mm-hmm. And just to remind people, what is CPI and what is PPI?
Great question, and it is one of those things you start throwing out all these acronyms, and but the CPI is a consumer price index, so that's truly what you're buying, what you're paying for your eggs on the table. The PPI number, the producer price index, is a future indicator. That's what the producers that are going to make those chickens to get the eggs to get to your table are paying. So the CPI is the consumer price index is what are you paying today, and what were you paying in comparison a year ago for that same product. The PPI is what's it going to take to produce future eggs down the road, and what you can look to. So if the PPI is going down but the CPI is up, then it means, okay, it's a good indicator. Prices will go down in the future. So two big important numbers to look at, and that's midweek next week that they will be rolling out.
And what was it last time? Do we know?
The CPI had ticked up to 3.8%, and that's why they were saying how, and they were expecting a bump. Inflation had gone down the month prior to that to 3%, and then took a tick up, and that was they anticipated that, for various factors from oil to a lot of other things, but not to mention a really quick drop a couple of months before.
And yeah, and another thing that we're up against a lot of times are what they call just adjusters. They'll adjust for times of year, they'll adjust for different things, and then all of a sudden they will decide they want to change their adjusters. So then it really throws everything off. So I mean, I think we're just in a weird spot right now as far as when he said the word digest. It's just difficult to digest when the targets are moving and they're not all the same. It's like just anyway, if you change anything, it's going to take a while to get a track record of that so that you can really understand where you are, I guess.
Well, and that brings up a good point, because here we are at the beginning of the fourth quarter, 2023. I'm going to say second weirdest year ever. But so now that we're at fourth quarter and you guys can go back and look and see how the digestion, I think that's a great word, Micheal. What did the market do for the first 9 months? Did it slow down? Did it keep pace? Were people still buying houses? Do you have any of those numbers yet from earlier in the year?
The market has slowed, and again, because of as Guy was mentioning, adjusters and other things, it's hard to really know until we really get into next year how slow was it. There are tech sectors and different sectors, just like there's going to be parts of the economy that increase. For what we're more focused on, the housing market and obviously the mortgage market, that has slowed considerably. And a lot of it is due to inventory on the purchase side of things. It's anemic to say the least. We're probably driving somewhere half of what a normal market, forget about a great market, a normal market. So when you said the second weirdest year, I would agree it's a weird year. It could be in some ways, like, a lot of people want to, take this year, 2023, and compare it to 2008. In some ways it's better. In some ways it's worse. In 2008, there was a growing, inventory wasn't the issue. If anything, we had too much inventory, foreclosures were happening and so forth. In other ways, it's not as bad because of the fact that we weren't making a lot of stated loans and 125 so the market was much more conservative, which will get us through this much better. much more stable. Housing prices, for the most part, have been, with the exception of certain areas, has still remained solid. We just need more. I think the consumer has to be more confident in that their job is going to be fine, that a lot of the things that this year will be fine going forward. And I think that uncertainty with rates has caused a lot of that apprehension. But there's also a lot of pent up for the future. So overall, looking back at the 9 months, we thought that rates were going to come down. A lot of folks have made comments rates are going to come down around May, mid-year. That didn't happen. Everybody thought that pent up anxiety of holding on to their homes would subside, and it hasn't. So the one thing we learned is you can't predict. There's so many other factors that go into things, and but all predictions are spring of next year is going to be a really good spring.
Well, and we're going to have to take a quick break. We've got lots more interesting financial discussion with Micheal Ronchetti and Guy Giles, Mutual Mortgage. Michael's joining us, the Regional Vice President of the Northwest, and Guy Giles, one of our sponsors on every month, trying to keep us informed and educated about all the weird stuff that's going on. We're going to be right back after a quick word from John L. Scott, Ashland, Medford, Guy Giles, Mutual Mortgage, and our local Rogue Valley Association of Realtors. Do not touch that dial. Well, hey, everybody. Welcome back to the Real Estate Show. I'm Alice Lema. I'm a broker here at John L. Scott Real Estate in Southern Oregon and your host of the show. And we're getting two brainiacs for the price of one today. We've got Micheal Ronchetti, the Regional Vice President of the Northwest of Mutual Mortgage, and our local Guy Giles. Thanks so much for being on today, you guys.
Well, thanks for having us back.
So right before the break, we were talking about kind of the last 9 months of 2023 as we get ready to go into the fourth quarter and kind of how the markets react. The real estate agents are noticing a lot of activity just since the end of August. Are you guys experiencing any of that? It's almost like a delayed spring market. What's going on in your part of it?
I think there is a little bit of, we've been seeing application counts on the rise for us. I do think there's some reality setting in with some of the consumers. For the folks that absolutely want to buy homes, or we're also seeing an uptick in refis, but I think that's a little bit for some different reasons. I think that's more about the inflation and the current state of the market and people having to consolidate. But on the purchase side, I think there's a reality that everybody keeps thinking rates are coming down tomorrow, and realizing that they're just have been going up, and now it's time to jump in. And it's, if we're going to refi down the road to lower the payments, let's do it. But right now it's time to buy, and it's sellers have been a lot more accommodative as the months have been going on, and making it much more a buyer market from the sales price standpoint.
Yeah, I mean, you mentioned somebody might not be sure about their job a little while ago, and this has still just kind of been on my mind. I actually had a guy Friday that he works for the government, and he said, I might hold off. He's like, I'm ready to buy. I told him, you're all ready to go. You're approved. And he's like, I want to make sure in the next 45 days, the government doesn't shut down before I can pull the trigger. So it's funny that we just added 190,000 government jobs, and who knows if it'll be funded or not. But this guy, I see from the video, because we're on YouTube also, a little confused look on Alice's face right now. So let me try to redo that a little bit. I have a guy that works for the government. The government almost shut down last week. They got a emergency Band-Aid put on it because all those third graders up in Congress and the Senate can't seem to do their job. So it really, at the end of the day, he's a little nervous about what's going to happen. They have funding for the next 45 days now, but it's not forever. So probably the answer for that is hire more people for the government, since their logic is good.
But as a lender,
anyways, but it's a real thing. You want to be stable in your job, and you want to make sure that everything's okay before you're going to buy. And that could be part of it.
But are you guys looking at the government employee applications differently? Because as old as I am, I haven't seen the government actually do a real shutdown.
No,
No,
there really hasn't been there have been shutdowns, none for greater than 25 days. And over the last 20 years, I think we've had 2 or 3 in total. The answer to your question, no, we're not looking at those. The things we look at differently, or maybe more, are commission income individuals that, and the commissions were based upon.
As well, you should.
Right. But as far as government workers, or like, for example, you have a lot of union folks, it's like every day, it's a writer's strike. Now it's the actors strike. You got the UAW out. You got the AFL-CIO with Kaiser up here in the Northwest on strike. So there's a lot of things that are there. Are we looking at them differently? No, not unless they're actively on strike. But typically when the government has shut down in the past, it's usually more about how to get a 4506T process for transcripts because the IRS is shut down or something's going on. But as far as the jobs and underwriting, no, that's not really. But for the consumer, if you're sitting there and you're working for the government and there may be a shutdown or something, that could cause you to say, hey, look, I want to, as Guy mentioned, I want to buy today, but I want to make sure my job is secure tomorrow. And like I said, we're seeing people coming off the benches who are waiting for that mysterious low rate to drop overnight, 300 basis points. And since it hasn't happened, now they're coming in, but now it's about job security, or, maybe there's some other factors, relocation. And that really has prompted areas like Medford, I think, to pick up, because we've seen a lot of outlying areas. It's not Seattle proper, it's the outlying areas of people wanting to move out from the city and get something more affordable and more area. So we're seeing those grow. Spokane, Eastern Washington really take off.
Well, and then when you mentioned the mortgage-backed securities dropping 300 basis points, what he really meant by that was a rate drop. And I'm not saying that if you're uncomfortable about your job that you should buy right now, but I can definitely with confidence say that if you wait for the rates to dump, you're probably going to be too late. Meaning you'll get a house, but it'll be the 6th one you looked at, and you'll be given one of your firstborn, as a bribe to try to get that house accepted. And that's going to happen overnight. So I'm just talking to people about, right now sellers are paying closing costs. Right now sellers are taking a little bit less. And it's the funniest part is that's at the same time that we're probably going to be 7% higher in home values at the end of this year. So, I mean, it's just nothing is really slowing down or stopping, but I don't think that this kid is foolish at all, to wait and see what's going on with his job. But at the same time, if you're prepared to buy, talk to your real estate agent and definitely look at those listings coming out every day, because I'm actually seeing people get some bargains for the first time in a few years. And it's not that housing prices went down, it's that sellers want to move on with their life too, and everybody's on hold. And sometimes you can get a little bit more than you may have in a really low rate environment, and you can always refinance.
And that's the part that is making me nervous is I'm remembering not that long ago during the shutdown and right after, the prices were going through the roof and people were overpaying. Appraisals weren't coming in. They were having to bring in lots more cash. And that is some of the prediction for when the rates start going down, is that the prices are going to go up unless the supply end is handled. And I don't know what you guys are seeing supply wise, but we're not seeing a ton. I mean, you can get for $450,000 in East Medford a really nice home with a swimming pool.
Yeah, and that's
nice like unheard of. And there's just not enough people putting their houses on the market. But what do you guys think will happen when the rates start going down? Because they will go at some point, someday.
No, well, it's going to be, as we saw in 2020 towards the end, in 2021, rates went down. The escalations went crazy again, and probably twofold. And inventory was probably normal for the most part during that time. but we saw, multiple offers because everybody could afford so much more now. And everybody was upgrading and then putting their homes on. So there was a natural flow for the most part of inventory at that time. What we're going to see right now, because we're anemic at best on our inventory, which has kept prices elevated. Normally, you would say in this time, if there's a slowdown and things are going, that why aren't we seeing housing prices drop? Well, we are in certain markets, Seattle proper and Portland and so forth, but we're not in most other areas. So it kind of overshadows that. And we're seeing housing stay pretty resilient through all this. When the rates come down, the housing prices will go up because, as you said, inventory is just not going to turn on a dime. It takes time to build a home, and you're not going to see that inventory start, taking off anytime soon. And if anything, we also have the Gen Zers are now at the age to buy homes. They're just looking for affordability. We have a lot of millennials still living in basements that are looking for that affordability to come back. When rates come down, you're going to have so many more buyers. It's going to be a seller's market. And it's going to be some time to weed through that. So prices will escalate potentially faster than what they were before.
So it's pick your poison.
Right, exactly. And to Guy's point, now is the time it's a buyer's market overall. And that now's the time to get those deals because, again, you can always refinance down the road.
And we still are running that. We're, for the next few years, not going to be running or paying or charging any bank fees anyway for people that refinance if they buy now. So,
that's good.
A lot of the cost of buying a house is your escrows where you're prepaying your taxes and insurance into that escrow account. So if you refinance or you think, wow, it cost this much money when I bought my house, the vast majority usually of the money is sitting in an escrow account, and that money still belongs to you. So when you refinance, yes, you do rebuild that escrow account, but you get that money back. So probably $5,000 to $6,000 of what you think is going to cost you to refinance is just a wash because you're going to end up getting a check back from the servicer with all of that in it. And then with us not charging the fees, the title insurance will be reduced also because if you're doing it within 3 years, then they assume that the place has had a title check recently. So you'll save a little bit of money, at least on the original refinance fees for that part of it. And, so it's not going to be as expensive as you think. I've never been a proponent of let's just get you in something so that we can refinance you later. That's not my heart. I'd love to get you in the right one at the right time. But I think at this point, it's just about getting into the right house at the right time, working with a good local lender to get you in there. And then you can really worry about it, as far as what your final loan's going to be in a few months when something happens.
Well, it comes down to if the housing market has been resilient with values, and if it's about the investment side is why, because to Guy's point, if you're just saying, hey, you're just going to refinance down the road, well, you have to, should I be buying then today? And the answer is yes, because if I know tomorrow it's going to be more expensive to buy that same house because of inventory and everything, then you absolutely let's get you in. And then we can always mitigate things down the road. But it's still a great investment, and the housing investment even today is still great to buy now because it's just going to go up later, and that's why we're seeing products haven't diminished in our world. If anything, there's been a lot of opening and expanding with things, and as mentioned on the 2 to 4 units expanding and LTVs. We're seeing a lot more non-QM products. And again, all that's because all the bean counters feel 2024 is still going to be a great year for values.
Well, and this is actually
maybe you can. Yeah, I know we're coming up on the break, but maybe you can mention what's going on with that Remax lawsuit that just happened. Tell us a little bit about it after the break.
Yeah. We'll have to take a quick break, but we definitely want to talk about how buyers may be faced with paying the real estate fees for their buyer agent representation. There's something afloat with National Association of Realtors and Remax kind of brewing. So we'll talk about that. We'll be right back after a quick word from our sponsors. Don't go away. Well, welcome back, folks. We're talking to Micheal Ronchetti and Guy Giles, both of Mutual Mortgage. And right before the break, we touched on two really hot topics. Let's take the investor loan changes that are coming from Fannie Mae for 2 to 4 unit dwellings.
Yeah, you know, one of the great things we're going to see, and we've been talking about in the prior segments about home values. Well, the one great thing about the market being resilient is it allows Fannie Mae, Freddie Mac, and then all other investors to start opening up things and find ways to being creative. And I think one great change that is coming is taking the 2 to 4 units, which historically have had to have 15 to 25% down, now going as little as 5% for primary. So that allows somebody that maybe is tight on funds to afford a home because they can use the rentals from the other units that they're buying because they're going to be living in one of the units, and it allows them to afford that housing payment at the end of the day. So that is going to be one really good change. The non-owner component, meaning you're buying it, you're not planning on living in any of the units, that's going to stay. But if you're going to occupy one of the units, which historically folks have really relied on FHA, and that had its own little caveats that used to kick deals. So this is going to be a great thing for Fannie Mae, Freddie Mac to come out and say, look, you can put as little as 5% down, get into a multi-unit home, 2 to 4 units, and be able to afford that property as a way to create home ownership, especially amongst, again, we talked about the millennials and the Gen Zers coming in. You know, it's just making sure you're dealing with realtors with the experience and mortgage loan originators that have that experience in that marketplace, because it's one that we capitalize on a lot.
Mm-hmm. Yeah, and it is different, especially in Oregon, because Oregon is still the only state in the union, I believe. It's still the only one that's completely statewide rent control. And that doesn't just have to do with the rent, it has to do with a lot of the other details. So getting more landlords to jump into that business in Oregon would be very helpful too.
It goes back, it just makes that investment that much even more so to take hold of, and that goes into effect in November. So
that's like right around the corner,
right?
Okay.
Yes.
And is that kind of a is that happening because the lenders are trying to relax a little bit just to help people get through this high interest rate time? Why is this coming now, I guess, is the question.
In the end, everybody will sit there and say, well, we're trying to do this, or we're trying to promote home ownership. But in the end, it comes down to risk. And again, the housing market values have not dropped, and it's allowed everybody to feel very confident in these type of risk investments. Now the ultimate goal up front on things is to create home ownership, get more landlords, have people to create wealth and income, and it will do that. And it will be a very positive move overall. But again, having that housing market stay strong, and again, we're seeing it not even just again in with Fannie Mae and Freddie Mac, but with the independent investors that fuel that non-QM world or qualified mortgage. So you get a lot of those. We're seeing a lot of guidelines, a lot of loan to value increases in those segments as well, and it's creating a lot more ability to lend at the end of the day.
And we need that right now during these high interest rate times. Although, we're all of an age, we remember 11 and 16% and people still bought houses, but the prices were, I remember seeing houses for sale in Santa Clara County back in the 80s for 150, maybe 200, but the rates were 11 and 16%. And that's how the market adjusted then. We don't see that right now. The prices are still pretty high.
Well, and that's one reason why we're luckily the job market has been for the most part resilient in that aspect for wages and so forth to try to get affordability. But make no mistake, it is weighing down. And again, that's one reason why I think a lot of folks don't jump in, but there is, like I said, it's prices are only going to go up, and if you have that ability to afford, and again, I think this move, which is going to roll out, I believe, middle of November, it's going to create a lot of opportunities for folks to jump in and earn some additional passive income to boot.
Now, you mentioned, and I just want to spend a quick second on this earlier, that the prices in Seattle and Portland and some of the other big urban areas are softer than they are in the outlying areas. Just kind of quickly, what's going on with that?
Well, some of that is, I always say, would be that geopolitical point where there's different things on why people are moving out, and some of it's just because COVID brought in some, a change. We realized we could work from home and many occupations. And so folks that were, living close to the city because they had that Amazon job that they had to go into the office every day and have that $3,500 a month, 1-bedroom apartment. Now they can go and they can put that into a home and have a yard and have 3,500 square feet. Which is the only 3,500 they're having to deal with. And, so we're seeing a lot of people migrate out. And then you have those areas where you have what we see on the news every night, and that are making people move out. Crime and so forth has affected these parts. So where you see inventory right now is you see it in Seattle, for example, the Green Lake areas and some of the other areas, that's where we're seeing an increase in inventory. So we're also seeing a decrease in value in those markets. Same thing in Portland as well. But you go out in areas that historically used to have the inventory, now is where it's depleted and values are going up.
Interesting. Very interesting. So we only have a couple minutes left, and we wanted to circle back about the strong possibility, I guess we'll say, of buyers having to pay their own real estate agents. They would actually see in Oregon, in a lot of states, the sellers pay both of the real estate agencies. Now there's a big brouhaha to maybe separate that. And so the real estate agents are sitting back wanting to ask the lenders, are you guys gonna change how you do pre-approvals so that the buyers have that flexibility? Or what are we going to do if this actually goes through and buyers have another $5,000 to $10,000 expense on their side just so they can have representation?
We haven't really got any guidance on any of this yet, but we have to really think about how that lawsuit actually was settled, and the sellers were already paying. I mean, let's face it, even though technically it comes out of, on the HUD-1, your final document, that it came from the seller. Well, that's all factored into the price. So you could almost say that the buyer's already been paying for the whole thing, because
that's true.
So, so, I mean, it's just going to be a gyration of, what do you call this and what do you call that? And do you call that a seller contribution? But I think what we can do before we meet next time is definitely do some research as far as what our guys and gals up that are smarter than me see coming down the road, and come up with some ideas.
Because it's all pretty new. Well, Micheal Ronchetti and Guy Giles of Mutual Mortgage, always great to have you on. You are just our brainiac lenders. Thank you so much.
No, I appreciate being here.
And we'll have you back on again because there's more to talk about. But now we've got to say goodbye. Have a great Southern Oregon weekend, folks. We'll see you next time.